about $100 billion valuation. This would make it one of the highest value companies to go public in a long time. It'd be more valuable in terms of market cap than Uber, than Lyft, and really all these major tech companies that we have seen. Did you hear what just happened with AMC? What happened with the newest movie that was released in theaters? No? Well, let's get right into it. So welcome back, guys. Welcome back to my channel. Hope you're having a great day. AMC, their stock price was just upgraded because Godzilla vs. Kong renewed a lot of confidence in the domestic box office because it had a very, very good weekend, opening weekend, considering everything going on. So Godzilla vs. Kong, it opened with about $48.5 million for the full 5-day Easter weekend in its opening weekend. And that was really, really good because when you look at back in May of 2019, Godzilla King of the Monsters opened to $47.8 million. Well, that was just, the weekend, Friday night, Saturday, Sunday, and this was a little longer, a 5-day Easter weekend. Still, this time around, even with movie theaters at half capacity in the US, they generated more revenue in the opening weekend for Godzilla than they did back in 2019 when theaters were completely open all across the US. And that is great news for AMC stock. AMC has raised a lot of money in secondary stock offerings. They have an additional 500 million shares that could be issued now that they're asking for approval from shareholders to be issued. And they can use this money to help build the business. But now, with this being, with what just happened with Godzilla vs. Kong, that is a really great sign because not only are movie theaters not open in full capacity, so they're opened at about 60% capacity across the US, but this was also released for streaming platforms on opening weekend as well. So considering that it was open for streaming platforms and movie theaters were only open about half capacity in the US, and they still were able to generate more money in this opening weekend than they did back in May of 2019 when theaters were fully open, that's a great sign for movie theaters and for AMC because that shows that people now are comfortable going back to movies. They feel like it is safer to go back, and people are excited to go to movie theaters even if movies are available on streaming platforms. So right now, according to analysts, AMC, they are since they are the largest exhibitor in North America and they operate the largest number of premium IMAX screens, analysts view AMC as well positioned to benefit from the industry's projected resurgence and return to pre-pandemic attendance levels by 2023. And they're saying that Godzilla vs. Kong is a sign of things to come and a sign that even with streaming and movies being released there, people want to have that experience and want to go to the movie theaters and are looking to get out again, and this is a great sign for the stock. Analysts upgraded AMC's price target. They doubled it from $7 a share to $13 a share, but the point isn't the exact price. The point is that they doubled the price target and that analysts have a lot more confidence in the stock than they did previously because of this opening weekend with Godzilla vs. Kong and how it did much, much better than people were expecting. No one was expecting it to do better than it did in May of 2019 for the previous Godzilla. So this was really great news, and we could see AMC stock price skyrocket this year towards the end of the year in early 2022 if we're continuing to see movies opening with these sort of with these sort of numbers. So we'll have to wait and see what happens there. But speaking of great news, Palantir was selected by the National Nuclear Security Administration for a massive 5-year, $89.9 million contract for something they called the Safer Project. So Palantir just announced that the Office of Safety, Infrastructure, and Operations, with a platform for effective knowledge management and data-driven decision-making, announced a deal worth about $90 million for 5 years with Palantir. And that is huge. This is going to help. This is the first time that Palantir has partnered with the National Nuclear Security Administration. Palantir works with a lot of other government organizations, a lot of big companies. They have deals with AWS, IBM, with the military, but this is their first deal with the National Nuclear Security Administration. So that's a big deal. This is a long-term contract which guarantees revenue for the next 5 years, and they're going to be doing similar work to they do with other companies, using data analytics, their platforms, their Foundry and Gotham softwares to help the NNSA measure the health of safety programs across the organization and provide timely insights into data. They're going to help them track, trend, query, analyze, and visualize safety metrics from different sites across the country. And for all of these reasons, this is why many people think that Palantir could be a $1 trillion company within the next, decade. They think this could be the next massive $1 trillion company because of what they do. They're in the data analytics space, and that's an industry that's not going away, and it's only going to continue to get bigger and bigger as the years go on. And having these deals and contracts that they're signing with government organizations, with massive Fortune 500 companies, with the largest companies in the world, all of these contracts keep adding on to Palantir. They keep building on one another, and all the contracts they have now are usually multi-year agreements. So every time they sign a new deal, that guarantees recurring revenue for like 3 to 5 years. On top of this, not only does signing contracts with government organizations, in my opinion, add a lot of confidence for other companies. If you see that one company is managing data for the, government organizations, for AWS, for IBM, that makes them very trustworthy, first of all. But not only that, Palantir now is switching their business model to allow for smaller companies to really be able to pay and sign contracts. So right now, a lot of the way that contracts work with Palantir is they're long-term agreements, a lot of money up front, multi-million-dollar contracts. But now Palantir is offering and are changing their business model to allow for smaller contracts, which opens the door to a brand new market of smaller businesses, like, mid-market cap companies that are maybe less than $1 billion in market cap or a couple $100 million that want to do business with Palantir, but maybe don't want to spend $20 million or have a multi-year contract where they have to pay a lot of money up front. So now Palantir not only has this deal with the NNSA, but they also are changing their business model to allow for more customers to be able to really do business with Palantir, which in my opinion opens the door up dramatically and really helps them out. I think this stock definitely is going to be a massive winner for years and years to come. It potentially could be $1 trillion company down the road if they keep going at this rate. Next up is GameStop. GameStop had breaking news the other day. They're capitalizing on the surge in stock price, everything going on with Wall Street bets, with the stock price going from like $3 a share all the way up to over $350 a share. Now they're capitalizing on this surge with $1 billion share sale program. So GameStop had been debating this for a while. They were wondering, should we issue more shares or should we not? It might look bad if they do it. So they've been debating that. But finally, they decided, okay, we know we need the money. In order to survive, we need to raise more money. We need to transform our business, pivot. And the only way we're going to do that is really by raising more money. The easiest way to raise more money at this point for them is by issuing more shares. There's a lot of the daily volume for GameStop is through the roof in terms of how many shares are being traded. And now with this, they can offer new shares. It's going to dilute shareholders their current positions. But what it is going to do is it's going to provide money for the company to succeed long term. I know everyone wants to make money in the short term and people, don't want them to issue new shares. But the reality of the situation is if the company doesn't make money long term, stock can stay up for a long time, but long term, the only way it's going to continue to do well, any stock, is if the company at some point is going to make money, because it can't last forever where the stock price is inflated. C-level executives at GameStop know the price is inflated. They know the valuation has nothing to do with the company right now. So they're using this to their advantage, raising more money. And according to GameStop, they said that they're going to be making an offering of up to 3.5 million shares, and the proceeds will be going to further accelerate its corporate transformation. So recently, GameStop has been on a hiring spree, hiring executives, a chief growth officer, a chief technology officer. They hired a new CFO. They've been hiring a lot of new people ever since Cohen, the founder of Chewy, came on the board of GameStop, and now they've been trying to really transform GameStop into becoming like the Amazon of gaming. They have a long way to go, but this money definitely will help. And some people aren't happy about it in the short term because, new shares being issued dilutes your position. But other people are actually pretty excited about it because a lot of people who are invested want to see GameStop around 5-10 years from now. And the only way they're going to be around is if they do change their business, pivot. And this money will definitely help them. So in addition to all of this, GameStop released preliminary sales for the first 9 weeks, the first quarter of 2021. And they said that total global sales increased 11% from the same period a year ago. And jumping 18% in March. So really a lot of this probably has to do with all of the attention that's been drawn to GameStop. Over the last 3 months, GameStop has gotten more attention than any other company in the news, especially in January, late January. So a lot of that has help the company, and not like dramatically, but so many more people are searching GameStop on Google Trends. More people are looking up the stock, looking at the website, and all of this traffic has led to some more sales for the company. Here's another story with STEM. So STEM Inc., currently their stock ticker symbol is STPK. They're merging together. So STEM Inc. is merging with Starpeak Energy Transition Corp. And on STEM's Twitter page, they had a new post about what they see in the energy storage space over the next couple of years from their VP program ops. And this interview with this high-level person at STEM explains how they see Joe Biden's infrastructure bill, how they see this actually benefiting the energy storage business. And what they're explaining is that right now, past year, we've seen a lot that's gone on with California, the rolling blackouts there, the Texas power grid crisis with the cold front that went through and millions of people lost power. And they're saying that right now, with all of that going on, it really sets the stage for STEM Inc. to have a massive rest of 2021 and the next couple of years, because they're saying a lot of these issues that have been in the background for a while now have really come to the forefront. And now this is where STEM Inc. and their Athena technology, their platform, really steps into place. They say that is where they can benefit California, Texas, all these different power grids, and this is what they do. They're going to help alleviate stress from the electric power grid. And not only that, but the VP explained how the Biden administration, they're focusing a lot on green energy and spending money on the power grid and on electric vehicles. And all of this is definitely going to help STEM Inc. So first of all, the stock price, it currently has dropped pretty significantly from highs earlier in the year of about $50 a share. Now it's more in the mid-20s. But with the Joe Biden administration pushing for a multi-trillion-dollar infrastructure bill that spends close to $600 billion on either electric vehicles, the power grid, things like that, that is a lot of money that's going to directly or even indirectly benefit STEM Inc. Because first of all, if you have more electric vehicles, that means you're going to need to have more people are going to be charging vehicles at their homes or at charging stations. More people charging vehicles, that consumes more electricity, puts more pressure on the power grid, more strain on the power grid. The only way to alleviate that is going to be with STEM Inc., their AI technology with Athena, telling the systems when to use energy from the power grid versus when to use energy from, let's say, battery sources or solar panels or from wind energy. So all of this is definitely going to help, and it's everything that's going on right now between the Joe Biden administration, between what happened in Texas and California, according to their VP of program, they say that this is definitely going to benefit STEM Inc. moving forward. And they see this as a big, big win for the company and for the stock over the next couple of years. Speaking of energy and Joe Biden's infrastructure proposal is going to be directing billions of dollars, hundreds of billions of dollars toward clean energy. And a lot of companies and ETFs are going to be benefiting directly from this and are set to have massive, massive years, especially after the recent pullback we've had. And analysts are saying now is probably going to be the best opportunity we're going to have to buy a lot of these companies. We're not going to see a better opportunity anytime soon. So clean energy stocks have taken a pretty big hit over the last month. But prior to that, they had a massive 2020. They did better than almost any other sector, better than almost any other stock. And now with this correction, according to JP Morgan, over the last month, they're saying this presents a buying opportunity. And they think this is a huge deal, especially with the unveiling of Joe Biden's infrastructure plan. So Joe Biden is looking to do a $2 trillion infrastructure bill, and there's about $628 billion for climate spending, including $174 billion for the electric vehicle market, $100 billion for power grid. And all of this money is going to be directed at these alternative energy stocks that have dipped recently and now are at good buying prices, according to JP Morgan. Some of the safer plays would be like ETFs, like iShares Global Clean Energy ETF. That's one, or Invesco Wilderhill Clean Energy ETF. Those are two different ETFs that had massive years in 2020. They more than doubled. And other stocks that aren't ETFs, but other stocks that are in the space are companies like Star Peak Energy Transition Corp, like I mentioned previously. Another one would be all of the charging station companies like ChargePoint, EVgo, EVbox. Another big one, which is not nearly as risky, which is just already generating significant revenues, over $1 billion in revenue, is Enphase Energy. Enphase Energy is one of my favorites. I talked about the stock on one of my channels back when it was at $93 a share. I think it was my second video on my channel called Michael Wrubel, stock that I've owned for a while now. Either way, you can't go wrong, according to analysts, with ChargePoint, QuantumScape, Enphase Energy, or one of those two different ETFs, iShares Global Clean Energy ETF or Invesco Wilderhill Clean Energy ETF. They're saying that these, while there's going to be a lot of volatility short term, they could fluctuate 20% within a week, 20% in a couple weeks. But long term, they're saying there's no better opportunity out there to make a lot of money than these in this industry right now. So anything in the alternative energy space with solar panels, energy storage, that is where they see the biggest opportunity moving forward. Speaking of electric vehicles, Warren Buffett-backed electric automaker BYD announced late the other day that their Q1 results are not going to be as good as they originally were expecting. So originally, they were expecting higher profits, higher numbers, but they reported lower than expected guidance for the first quarter, which only accounts for 3 to 5% of what analysts are expecting for the entire year of 2021. And according to Credit Suisse, they're saying that the decline in profit really has to do with seasonal weaknesses in China. A lot of times, first quarter in China is typically like a weaker quarter because of the Chinese holidays, shutdowns in factories, and things like that. So that's what they're attributing it to. But in my opinion, like NIO and Tesla, their sales in China did better than expected in Q1 of this year. Like originally they had all the same issues and challenges as BYD, but their numbers ended up being even better despite all of these issues. So my opinion is, BYD obviously, even though there are challenges, they're obviously not doing as well as like a company like NIO or Tesla in terms of brand awareness, in terms of of capitalizing on the opportunity in the electric vehicle market right now. But so BYD is backed by Warren Buffett. This is the electric vehicle company that he has picked to back, and they're saying that net profits attributable to shareholders in the first quarter will be between $30.4 million and around $40 million. So they're saying really the main reason why profits are going to be lower is because there's been a lot of pressure on in terms of their raw material costs. They say raw material prices for like lithium carbonate, electrolyte, and copper, all of which are used in their vehicles, have gone up significantly. Battery costs are still pretty expensive. Shortages with semiconductors and chips. That's all been impacting them. And so they said that's why they're going to see net profits lower than they originally expected. Either way, long term though, nothing to worry about, nothing to be too concerned about, because analysts are still projecting a 67% return this year for BYD. They're saying stock price is going to be 310 Hong Kong dollars versus right now, which is at 170.4 Hong Kong dollars. So still projecting between a 60 and 90% return this year. Still a great stock to own, BYD, and we'll have to wait and see what happens. But this is the electric vehicle company that is backed by Warren Buffett. So we all know that he likes to invest in companies that generate profits, that aren't spending so much money and losing money every year in terms of, spending on innovation and things like that. And this is one of those companies. Speaking of a company that has been doing really well lately, DraftKings. DraftKings is one of my favorite stocks, sitting right around $62 a share. And they just announced they acquired Israel-based Blue Ribbon Software, and this is a pretty big deal. DraftKings has been on a roll. Not only are they doing well because sports betting is becoming, is going to be legalized in more and more states across the U.S. We're seeing probably within the next year to year and a half, almost all states in the U.S. are going to have either a bill passed to legalize sports betting or going to have something at least proposed to legalize sports betting. But now they announced they've acquired Blue Ribbon Software, undisclosed amount, but Blue Ribbon is described as a Tel Aviv-based leading global jackpot and gamification company that provides platform agnostic, real-time gamification tools that allow for fully customizable jackpot promotions. And DraftKings say that they'll now be able to enhance the customer experience by integrating Blue Ribbon's unique jackpot functionality, including personalized promotions and rewards tailored to the individual customer or jackpots that pay out across DraftKings' various product offerings. So now they're going to be fully integrating Blue Ribbon's leadership, current employees, and things like that into their company. But now DraftKings will be able to offer more personalized promotions and use all of the features and benefits of this global jackpot and gamification company in their business. And I think this is just going to set them up even more to have a massive, massive year in 2021. DraftKings is by far one of my favorite stocks right now. Their revenue growth has been close to 100% year over year. Right now it's at 90%. And this is a major position in ARK Invest ETFs. This is one of, a big position for me. And between sports betting being legalized in the US, between in Canada, and between DraftKings having major partnerships with the NFL, with the UFC, with a lot of different organizations, this is one of my favorite stocks in the sports betting, sports legalization place. And I definitely think this acquisition is only going to help them. Speaking of stocks that everyone seems to really like right now, Lucid Motors, currently its post-merger valuation is sitting right around $34 billion. And some analysts are saying that this undermines the strong potential it actually has moving forward. They're saying that with this high valuation, a lot of people may be overlooking it or think it's just a hype stock, but they're saying it actually has so much potential. So currently for Lucid Motors, deliveries for the company are internally currently forecasted to rise to 50,000 units by 2023 and 90,000 cars by 2024. They're projecting that they'll have $10 billion in revenue in less than 4 years. And this is one of the fastest projected rates of growth of any company in the market right now. But I think they could actually do it because their vehicles sell for a high premium. A lot of them, at least their starting vehicles, are going to be for over $150,000 per vehicle. So they don't need to sell that many of them. They don't need to sell hundreds of thousands or millions of cars. If they sell tens of thousands of cars, that's going to already generate a lot of revenue because each car is going to cost, over $150,000 for consumers, at least at the beginning. But right now, post-merger valuation is between $38.5 billion. And a couple of things that I really like about the company that people aren't talking about, and it's going to indirectly benefit them. Besides them getting their vehicles, their first vehicles are going to be off the production line later this year in 2021. Besides that, continuing to build out their factory, and besides Project Gravity, which is their SUV that they're currently working on, one thing that's indirectly going to benefit the company significantly is Biden's push for more development of EVs and for infrastructure. So currently Joe Biden proposed a $2 trillion infrastructure bill, and this bill is proposing to build a network of 500,000 EV chargers by 2030. It has a lot of tax incentives for companies that are in clean energy storage, electric vehicles, things like that. So that's all going to help Lucid Motors significantly. More government backing for EV and EV infrastructure will help accelerate the adoption of EVs over the coming years, will make battery prices less expensive for car manufacturers, which will in turn drive the prices of electric vehicles down as well. And if batteries last longer and these vehicles cost less money, it's going to be a no-brainer for consumers to start switching over. If people know their vehicles can last very easily on a single charge, and if they run out of battery, they can charge it somewhere else, just like a gas station, gives someone a sense of security to say, okay, well, I wasn't sure about switching to an electric vehicle, but now that I know there's a lot of electric charging stations, I'm not worried about running out of battery, getting stranded somewhere, and the vehicle is, the same or even less expensive than buying just a combustion engine, a gasoline-powered vehicle. So for those reasons, I think that Lucid Motors has a lot of potential, and some people are overlooking it or just thinking it's a hype stock just because of everything going on. Yes, it is extremely high valuation right now, but they've already had maxed out their total number of reservations for their initial vehicles. They're working on making lower price vehicles in the future, and they're already on stage 2 of building out their factory, which will allow them to start producing their SUV, lower price vehicles, and continue to grow the company. So a couple of things there. There's a lot more to like about Lucid Motors with their Second Life battery program, which will reuse batteries in the future, and a lot of other things as well. But those are just some things that I think people are actually looking past, which are actually pretty important. Next up is Janet Yellen. Treasury Secretary Janet Yellen is pushing for global minimum tax on corporations. And while you guys probably don't think this is too important, it could be a pretty big deal because increasing taxes on corporations, especially with tech companies, could have an impact on the stock market, at least in the short term, if this were to go through. Long term, it would also have an impact as well, because if companies have to pay higher taxes, that means they have less money to spend to innovate, to grow, and things like that. So right now, under the administration's proposal, under Joe Biden's recent proposal, the corporate tax rate would climb to 28% from 21%. Former President Donald Trump had slashed the rate from 35% down to 21%, but now they're proposing to increase this as a result of what has been going on in the economy. Janet Yellen told the Chicago Council on Global Affairs that together we could use a global minimum tax to make sure the global economy thrives back on a more level playing field in the taxation of multinational corporations and spurs innovation, growth, and prosperity. So in reality, taxing corporations more is not going to help pay off debt or anything, the U.S. deficit anymore, because increasing by 7% isn't going to change a lot in terms of the trillions of dollars, the deficit for the U.S., but it could have some impacts on some of these smaller, fast-growing tech companies. A lot of times when we see taxes rise, tech companies are hit the hardest. So we'll wait and see what happens here, but this is what they're currently talking about in terms of corporate taxes, going from 21% to 28%. Another really exciting piece of news is Coinbase. Coinbase is set to have its IPO be listed on the NASDAQ on April 14th, 2021, under the stock ticker symbol COIN, COIN. And I think, first of all, let's just talk about that stock ticker symbol. That is a great ticker symbol for a company that is in the financial services space. COIN. They talk about having common names, easy names, or easy stock ticker symbols. It's a good thing. It doesn't hurt. It's not going to make the stock price do any better, but it's a very easy stock ticker symbol for people to remember. But anyway, so Coinbase right now, they had a great year in 2021. Their revenue, their numbers were really good. They grew 34% year over year in terms of users. So they have over 43 million users. The company registered a profit of $322 million in 2020 with $1.2 billion in revenue. So about a 25% margin there. And that's really just because Bitcoin's price has been doing extremely well. As Bitcoin's price does well, Coinbase does better. So obviously this could fluctuate quite a bit if Bitcoin has a massive sell-off like we've seen in years past. Do I think that's going to happen? I don't think we're going to see as big of a sell-off as we've had in the past. Bitcoin is starting to become widely accepted with major corporations, major investment banks. So I don't think that will be an issue, but Coinbase's valuation will be tied, will be correlated, I believe, to Bitcoin's prices because they do make more money when Bitcoin continues to go up. But right now, based on the private market, NASDAQ's private market last month, CNBC calculated that Coinbase will be going public around the $340, $350 per share range, which would put the company at about $100 billion valuation. This would make it one of the highest value companies to go public in a long time. It would be more valuable in terms of market cap than Uber, than Lyft, and really all these major tech companies that we have seen. This is going to be the highest in terms of valuation. And right now, if we continue to see Bitcoin's price go up, there's going to be a lot of demand the opening day for this stock. I think we could see whatever this opens up at. We don't know yet, but I think we could easily see this have a really big pop this first couple of days it goes available, because anyone who's invested in Bitcoin is a Bitcoin fanatic, loves cryptocurrency, believes in that. They're going to be all over this stock. They're going to want to get into Coinbase. So we'll see what happens here. But they are predicting between $300 and $350 for the IPO price. That could change, because I think it will be higher considering how much demand there will be for it. But it's going to be going public, officially listed, officially able to be bought on April 14th under the stock ticker symbol COIN. And we'll get some more details in the coming days as the IPO gets closer and closer. And other big news is with stimulus checks. So the fourth stimulus check has been gaining some traction. It was proposed by 60 legislators in Congress just the other day, and a group of 60 legislators currently sent a letter to Joe Biden and Vice President Kamala Harris. There were two groups of Democratic lawmakers that asked to continue stimulus payments and expand unemployment benefit and the expanded unemployment benefits. They're calling for recurring stimulus payments, and these letters were led by 11 senators, which were including Bernie Sanders, Elizabeth Warren, and 53 representatives who were ushered forward by Democrat Ian Omar. So what the letter said is that we urge you to include recurring direct payments and automatic unemployment insurance extensions tied to economic conditions in your Build Back Better long-term economic plan. The crisis is far from over, and families deserve certainty that they can put food on the table. So essentially what they're saying is that in Joe Biden's $2 trillion infrastructure bill, they believe that there should be more stimulus. They think there needs to be recurring stimulus because many families still don't have, their jobs back. They're struggling to put food on the table, and the pandemic isn't over. Even though we have vaccines being rolled out, a lot of families are still struggling financially, and they think the only way to, one of the ways that could best help these people is to pass another stimulus check. So I'll let you guys know what happens here. They've talked about $2,000 per month in terms of stimulus checks. I don't think that much would happen if we do see another stimulus check. I think it would be closer to what the second stimulus check was, which was around $600. But we'll wait and see what happens. Currently, the boosted unemployment benefits are going to be continuing through September 6th at $300 per week. Stimulus checks have been sent out. The third stimulus check, which was $1,400, has been sent out to most people by this point. And now they are still talking about a fourth stimulus check. So I'll make sure to keep you guys updated on what happens there. But that's really what's going on with stocks, stimulus checks, a couple of IPOs, and some exciting news with GameStop. So hope you guys enjoyed today's video. Don't forget to get your 4 free stocks valued up to $1,600 when you download the Wrubel investing app using the link down below. It's free money. All you have to do is download the app. Hope you enjoyed, and I'll see you guys in the next episode.